Okay, you're welcome to today's class. Today we are actually going to be looking at group account, everything about group account. So there is no time to waste. With your prior knowledge in group account, we shall take this practice question 1, to look at it. It's a very simple question, and know at least to remind ourselves what we are talking about when we say group account. Now, the question reads thus: the trial balance of Udo PLC and its subsidiary Aloma PLC as at December 31st, 2014 are given below. We have property, plant and equipment. We have loan to Aloma. We have other investments. We have current assets. We have 1 naira equity shares. We have share premium. We have retained earnings. We have revaluation surplus. We have loan from Udo PLC, and we have sundry payables. You would observe that we have 4 columns here. The first 2 columns is for Udo PLC, while the last 2 columns is for Aloma PLC. Now, this statement is prepared as at 31st December 2014. Good. So we'll now look at the additional information given to us. It reads thus: Udo PLC on January 1, 2014 acquired 75% of the equity of Aloma PLC for 1 billion 300 million naira, when the retained earnings was 600 million naira and the share premium was 170 million naira. Full stop. Neither this transaction nor the loan notes for the same amount obtained to finance the purchase were recorded in the trial balance above. There had been no impairment in the value of the goodwill, nor a change in the share capital since acquisition. It is the group policy to value the non-controlling interest at the date of acquisition at their fair value. The fair value of the non-controlling interest in Aloma PLC at the date of acquisition was estimated to be 160 million naira. Required: prepare the consolidated statement of financial position of Udo PLC as at December 31st, 2014. Now, this question is very simple. Now, let's look at the explanatory notes. I normally provide these explanatory notes to help my students in understanding the question. 1. The acquisition transaction has not been recorded in the trial balance. So the amount we spent to acquire Aloma has not actually been effected in the trial balance. So you are the one now, or we are the one to effect that transaction. 2. The loan note of 46 million naira was given by Udo PLC to Aloma before acquisition. Now that both are considered as group, the loan will be eliminated because it is an intra-group loan. How do we mean by intra-group loan? Now, when Udo gave Aloma a loan, that loan will be treated in the book of Udo as an asset, while in the books of Aloma it will be treated as a liability. Are you there? Now, that is why if you go back to the question, you see that this 4.6 million was treated as an asset in the books of Udo because Udo is the giver, while in the books of Aloma it was treated as a liability because Aloma is the recipient. So since they are now group members, you are not expected to report intra-group transactions in the statement of financial position. They will be eliminated. The rationale behind this is you are only meant to report transactions with third party, not transaction with family member. So group members are family members, so a debt to a family member shouldn't be reported as a debt. You understand? Good. So we'll go back to explanatory note 3. We are now in 3. The purchase consideration is 1,300,000,000 naira and was financed through loan. Udo acquired Aloma, and Aloma demanded that Udo pays it 1.3 billion naira. Aloma didn't have that money as at that time, so Aloma decided to take a loan, and the value of that loan is 1.3 million. So there are two transactions there. One, our cash will increase, and two, our liability will increase. Now this our cash, we gave it immediately to Aloma PLC, so we now have increase in cost of investment of 1.3 million and increase in loan of 1.3 million. You see the way we treated it when we get there. So we'll continue. We'll now look at 5. The NCI is measured at fair value. So the fair value of NCI, it was 160 million. Goodwill has not been impaired so far. That is that. So we'll now look at workings. The first working you are meant to do is to calculate your net assets, which is called capital and reserve. Now for you, when you want to do or calculate net assets, 2 things or 3 things should come to your mind. The value of equity, the value of share premium, the value of retained earning of the subsidiary. And who is a subsidiary here? Aloma. So we now have the equity of Aloma is 200,000. You can see it. The share premium is 170, and the retained earning is 662 as a date of reporting. As a date of reporting. So we continue. Now, DOR means date of reporting, while DOA means date of acquisition, while PARE means post acquisition retained post acquisition retained earning. Now, equity is 200,000. Share premium is 170. Now, retained earnings as a date of reporting is the date of balance sheet or date of financial position, and it's 662. You can see it. 662. Look at it here. 662. Now, as a date that he acquired Aloma, the retained earning is 600. So date of acquisition, the retained earning was 600. Date of reporting, the retained earning was 662. So the difference will give us post acquisition retained earning, which is 62,000. So you now add up. So this total figure is actually our net assets. So net assets as a date of reporting, and net asset as a date of acquisition. So we are interested in the 970 because that is the net asset as a date of acquisition. So we'll move down to calculate our goodwill. The purchase consideration, which is cost of investment, we already know, I explained it, is 1.3 million naira. Look at it. Now net assets was valued at fair value, and the value of net NCI was 160 million. That is how we got this 160 million. So you now add up, you have this value. So you now bring in your net asset. Your net asset is 170. The net asset is 170, and it is actually workings number one. So you might not say you have goodwill of 490. Move to working number 3, which is NCI at date of reporting. Now the NCI at date of acquisition was the one they gave us, 160 million. Look at it. Then you now add pare. Now pare, how do we get 25%? Since the percentage of acquisition is 75, that means the remaining is 25. That 25 belongs to NCI. So NCI will take 25% of the post-acquisition retained earning, and that gives us 15.5. So you add up, you now have this. That understood. We now move down to consolidated retained earning. Then, what do we mean by consolidated retained earning? We're actually looking for the retained earning to be taken to the consolidated statement of financial position. So the first thing you bring is the parent company. PC means parent company. You bring in parent company retained earnings. We have 5.8 million. You now bring in pare. You have 62 times 75%. Now how do we get 75%? That is a percentage acquired by the holding company. So that is what they will take of the post-acquisition retained earning of the subsidiary. That gave us this. So with this, you add up, you now have our post-acquisition retained earnings. So we now look at the solution. We are done with working. So we have Udo PLC consolidated statement of financial position as at the 1st December 2014. Assets, non-controlling assets. We now have PPE. PPE, you add the PPE of the parent and the subsidiary company. If you check back in the equation, you will see that the PPE is actually 260 and 60,000. Look at this. PPE 260 and 6,000. So that is how we got it. Good. So that will give us 6,260. So we now have goodwill. Goodwill is 490. Goodwill is 490. Goodwill is 490. We now have loan notes. The loan of the parent company is 4,600. Plus the loan plus the loan of the subsidiary. The loan of the subsidiary is 0 because there is none for subsidiary, then minus intra-group loan, and that will give us nil. That is how this nil was gotten. I hope you are there. Good. Then we'll now come to other investments. Other investment is 1,002 in the trial balance. So you add up, you now have total non-current assets to be 7,950. Then we now have current assets. You now add the current assets of the holding company plus the current assets of the subsidiary. That gave us this. So if you add together, you now have total assets to be 9,828. So we now look at equity and liability. So equity is 400. You only take the equity of the holding company alone. That's what you take, and that equity is 4,400. Share premium, you take share premium of only the holding company, which is what, 1,000. The valuation surplus is 60. You take it, that of the holding company alone. We now bring our consolidated retained earning, which is working number 4. You remember the working number 4 we did. We have this. So if you add up, you now have our total equity for the controlling interest holders. You now add your NCI. We did workings for NCI, and it's 175.5 to now be 7,482. That is total equity. Now, so we now move on and look at loan notes. Now remember that Udo collected the loan of 1.3 billion naira to finance the acquisition of Aloma. So he is owing. That is where we got this 1,300 plus the 4/6 of the loan Aloma gave to Udo minus intra-group loan. You see, we have minus 4/6 here. We minus 4/6 here. Now we are also minusing 4/6 here because they were loan that they gave to each other. So it's called intercompany loan or intergroup loan. So it is eliminated. That's why we are minusing it. So at the end of the day, we now have loan note to be 1,300, which is actually the loan that Udo collected from third parties to finance the acquisition. So that said, we now move down to current liabilities. So we now have sundry payable. So the one of the holding company plus one of the subsidiary will now give us total current liabilities. So we now add up, we have total liabilities, and total liabilities is 2,346. So we now have total equities and liabilities, which is 9,828. And you can see that the equation actually balanced. So that is that for that about practice question 1. So we will take a second question. Okay, now we take practice question 2. Practice question 2 is a very longer question that has statement of profit or loss, and statement of financial position, and statement of changes in equity. So you can see it. So we'll take this question to buttress our point. Take it to buttress our point. So the questions actually started from here. So we'll read. Statement of financial position as at December 31st, 2014. So the date of reporting is 31st December 2014. Note that the date of reporting is 31st December 2014. And remember, we'll give the note to you at the end of the class. So we have assets, non-current assets, property, plant and equipment, investments. We have current assets, cash at bank and in hand, trade receivables, inventory, equities and liabilities. We have share capital, share premium, retained earnings, current liabilities. So we now have statement of profit or loss for the year ended 31st December 2014. We have revenue, cost of sales, gross profit, distribution cost, administrative expenses, profit before taxation, income tax expenses, profit for the year. We now have retained earnings brought forward, retained profit for the year, then retained earnings carried forward. You can see that the questions has two columns. The first column is for Hapu PLC and Sege PLC. Hapu is the holding company, while Sege is the subsidiary. So now look at the additional information. Hapu PLC owns 80% of Sege shares. So if Hapu, being the holding company, is holding 80, the subsidiary is holding 20. Are you there? Good. These were purchased in 2011 for 20.5 million cash. The retained earning stood at 7 million. Included in the inventory of Sege was goods purchased from Hapu for 3.9 million. Hapu PLC aims to earn a profit of 30% on cost. So this is markup. Good. Total sales from Hapu PLC to Sege PLC were 6 million. So this sales becomes intergroup sales, and I told you earlier on, intergroup sales should be eliminated. Good. Hapu PLCs and Sege PLCs propose a dividend before the year end and 2 million and 2.5 million respectively. Now accounting entries have yet been made for these. Hapu PLC has carried out annual impairment tests on goodwill in accordance with IFRS 3 and 36. There was no impairment of goodwill. You are required to prepare the consolidations. Now we have the explanatory notes. In the explanatory notes, 1, the unrealized profit on unsold inventory is 9 million, which is 0.9 million, which is 3.9 times 30 over 130. That is how we do markup. So whatsoever it gives you becomes your unrealized profit. So master that. If it is markup, you do it like this. If it is margin, you apply direct. In the consolidated statement of financial position, they deducted the amount should be deducted from the consolidated inventory and consolidated retained earnings in the CSOPL. It shall be added to the consolidated cost of sales. So in the CSOFP, there are 2 entries. 1, minus it from inventory consolidated and minus it from consolidated retained earning. Then for additional information, 2, the intergroup sales of 6 million shall be deducted from sales consolidated revenue and consolidated cost of sales. Then additional information 3, the proposed dividend has no effect on any account and shall be disclosed as a note to the financial statement. Good. So the last explanatory note is there is no impairment of goodwill. The question remains silent on the method of measuring NCI, hence the proportionate method will be used. So we are going to use the percentage of net assets acquired method. So we now have workings. So working number 1 will be computation of net assets as usual. We're going to calculate the net assets as usual. So the share capital and the retained earning. So we have date of reporting. So the date of acquisition, the equity share capital of this man is 10,000. Then 37,000 naira is the retained earnings. It doesn't have share premium. But on date of acquisition, the retained earning was 20.7 million naira. So look at it now. So that's why we have on date of acquisition, it is 10,000. Retained earning is how much? The retained earning is 7 million. So we now have 10,000 and retained earning is 7,000. So that gave us 17,000 as net assets. Then we have date of consolidation. We have 37 million. It was what was as retained earning. So if we are now 47, but we are interested in the 17,000. So we'll calculate our goodwill. Cost of investment is 20.5 million. That was what the asset was purchased. You can see it. The asset was purchased for additional information. You can see it. They said it was purchased for 20.5 million naira cash. I hope you can see it. 20.5 million naira cash. So that is how we got that value here. That's how we got this value. So with this value now, you now add NCI. Now remember, we are going to measure NCI using proportionate method. So the net asset is 17 million. So multiply it by 20%. You now have 3,400. So add up, we have 23,900 naira. You understand? That becomes the total purchase consideration. Then less net assets. We now have 17,000, which is the net asset. We now have 6,900 as the goodwill, and there is no impairment. So that is where we stop. We move to working number 3, the calculation of unrealized profits. I've told you already how that is done, and in the explanatory notes. So I repeated it here also. 30 divided by 130 times 3.9 million. We have 900,000. So working number 4, calculation of consolidated retained earning. The first thing you bring in is parent company retained earning. You bring in parent company retained earning. That's the first thing you bring in. Parent company retained earning is the first thing you bring in. So here we are supposed to have our parent company's retained earning brought in here. Our parent company retained earning brought in here. So with this so far, we now have PC, you understand, parent company retained earnings. So it is this value, 55,000. We now bring in share of post-acquisition retained earnings. So the post-acquisition retained earning, which we got here, 30,000. So parent company will take 80% and NCI will take 20%. That is what we did here. So parent is taking 80%, which is 24,000. So you less the unrealized profit. Remember in the explanatory note, I said you deduct unrealized profits from the consolidated retained earnings. So we have this value, 78,100. So NCI is simple. NCI date of acquisition, then NCI will take their own percentage of post-acquisition retained earning. We have 6,000. That is how we have 9,400. So that is all. So we now consolidate. The first consolidation we're going to look at is the first consolidation is actually revenue. So revenue, you add the revenue of the holding company, the revenue of the subsidiary, then you minus the intra-group revenue. You understand? That is how we got this. The cost of sales of the holding company, cost of sales of the subsidiary minus intra-group's cost of sales, which is 6,000. You understand? Then you now add your 9,000 unrealized profit. That is how we got this. Now, sometimes you have to first of all cram all this, what to add and what not to add. As you practice often, it becomes part of you. We now have gross profit. Gross profit is this minus this, will now give us gross profit. So we now come and take care of distribution cost. The distribution cost of the holding company plus the distribution cost of the subsidiary will give us this. Administrative expenses of the holding company plus that of the subsidiary will give us this. So you just pick the figures from the equation. So once you pick this from the equation, it is easy for you to go. So we now have PBT. So we minus all this from gross profit, you have this as our PBT. So we now have income tax expenses, the same, you add the both. So we now have, so this profit for the year is 6,100. So we have profit attributable to. Now the holding company, what the NCI will first be calculated for. the NCI will first be calculated for. So 20% is the NCI percentage. So this 22,000 is the profit that the subsidiary made that year, and it's in the question. So that will give you 4. So minus 4,000 from this. So minus 4,000 from this, you now have this value. So 4,000 will be minus from 36,100 naira. So you come here, you have so we have 36,100 minus 4,400. So that is how we got this. So we now have consolidated statement of financial position. So for consolidated statement of financial position, we have non-current assets to be 32,000 plus 25,000. That will give us this. So goodwill, we already calculated goodwill. You bring it in. You understand? Good. Investment, you now add the investment of the subsidiary plus the investment of the holding company. That will give us this. Then we have investment, the investment in the holding company's account minus the intra-group investment. The intra-group investment is 20,000. How much? Is 20,500. Is 20,500. Yeah. Is 20,500. Let's check the question. It's 20,500. 20,500. So 20,500. This was actually a typo error. 20,500. 20,500. So that will give you 13,000. Are you there? Good. So you now add all of them to give you total non-current assets of 76,900. You now take care of current assets. So current assets is cash and bank. You add the holding, the subsidiary, trade receivable, the holding, the subsidiary, inventory, the holding, the subsidiary, then minus our unrealized profits. So you now have this. So you add up, you now have total assets. So we now take care of our equities and liabilities. So our equities and liabilities, we have share capital 4,000. We have share premium 6,500. We now have retained earning, which was the work we did. Now the share capital and the share premium will only be that of the holding company alone. So we now have retained earnings. You bring the value, which is working number 4. So we have NCI working number 5. We have this value. So we now have put together. So now we now have current liabilities. You bring in the value of the holding company and the value of the subsidiary, which is this. The value of the holding company and the value of the subsidiary. So that will give you this value. So you add up, you have this total equity and liability. So if you check this and also total assets, it is the same value. So that is that for today's class, and I hope you understand. As I said, we are dropping this question with you. You can come back to listen to the class teachings or tutorial again, and also read the notes. Definitely, success is just your best right. All you need to do is be consistent in coming to listen to the class and also reading our notes. You don't need to read back or buy any textbooks. You're welcome. Do have a nice night.